In today's special episode, we're delving into the mind of one of the world's most legendary investors, Warren Buffett. With the economic horizon showing signs of a potential recession, understanding Buffett's approach could be the key to surviving and thriving in uncertain financial times. We're breaking down the Oracle of Omaha's top 8 strategies to prepare for a recession. These tips aren't just for the financial gurus. They're essential, practical advice for anyone looking to safeguard their financial future. Let's delve deeper into Warren Buffett's number one strategy for recession preparation: build liquidity. Imagine this scenario. The market is down and high-value stocks are available at a fraction of their usual cost. This is the moment Buffett prepares for by building liquidity. Building liquidity means having accessible cash reserves. It's like filling a war chest, anticipating opportunities during a downturn. But how do you create this liquidity? Start by regularly setting aside a portion of your income into a savings account. Cut back on non-essential expenses, and consider consolidating high-interest debts to free up more cash. Let's take a look at a practical example. During the 2008 financial crisis, Buffett's Berkshire Hathaway had significant cash reserves. This allowed them to invest in companies like Goldman Sachs and General Electric, acquiring stakes at bargain prices. When the market recovered, these investments paid off handsomely. So the key takeaway? In the words of Buffett, cash is to a business what oxygen is to an individual. Never thought about when it is present, the only thing in mind when it is absent. Remember this wisdom as we explore Buffett's second strategy for recession-proofing your finances. Moving on to the second of Buffett's strategies for recession preparation: invest in proven companies. Buffett advises looking towards established blue-chip companies during economic downturns. But why these companies? These companies have stood the test of time, demonstrating resilience through various economic cycles. Investing in them during a recession can be wise, as their long-term value often remains intact even if their stock prices temporarily dip. For instance, take Apple Inc. During the 2008 recession, its stock price saw significant drops. However, those who invested in Apple during that period would have seen remarkable returns as the company continued to grow and innovate. This is a classic example of Buffett's strategy in action, identifying strong companies with solid fundamentals likely to rebound and grow over the long term. Understanding the strength of proven companies is vital in times of recession. Now let's explore Buffett's third strategy to help us navigate economic uncertainties. Stick with the normal game plan. In the face of a looming recession, it might be tempting to change your investment strategy radically. However, Buffett counsels against this. So what does sticking to your regular game plan entail? This means continuing with your established investment strategy. If you are regularly investing in a diversified portfolio, maintain that course. The idea is not to be swayed by market panics or to chase after risky, high-reward investments suddenly. Think of it like steering a ship through a storm. The key is to hold your course, not to make drastic turns based on fear or speculation. During the 2001 dot-com bubble burst, Buffett remained focused on his long-term investment principles, avoiding the speculative tech frenzy. This steadiness allowed him to avoid significant losses and capitalize on the market's eventual recovery. Remember, consistency is critical in uncertain times. Next, let's explore Buffett's fourth piece of advice on recession readiness. Avoid putting all your money into no-growth assets. During uncertain economic times, it's a common instinct to move investments into safer assets like saving accounts or government bonds. But what does Buffett suggest? Buffett warns against the temptation to shift all your investments into assets with little growth potential. While these might feel safe, they offer little in terms of long-term gains. For example, during the 2008 financial crisis, Buffett strategically invested in companies like Bank of America, rather than converting everything to cash or bonds. This move might have seemed risky at the moment, but it aligned with the strategy of not putting all his eggs in the no-growth basket. As a result, when the market recovered, these investments yielded significant returns. Understanding the balance between safety and growth is crucial, especially during economic downturns. Now let's move on to Buffett's fifth strategy for preparing for a recession. Keep a long-term outlook. During a recession, focusing on short-term losses and panic is easy. However, Buffett's approach is different. What's the long-term outlook all about? This strategy is about maintaining a broader perspective. Recessions, though challenging, are temporary. Historically, markets have always recovered and grown over the long term. Buffett's approach during these times? Stay the course and keep an eye on the future. Consider the tech bubble burst in the early 2000s or the 2008 financial crisis. Those who maintained their investments and resisted the urge to sell off during these challenging times eventually saw substantial recoveries. Buffett held on to and even increased his investments in companies like Coca-Cola and American Express during these periods, demonstrating his confidence in their long-term value. The number 6 is to prioritize emergency savings. In addition to the previous strategies, Warren Buffett emphasized the importance of building a robust emergency fund before a recession. An emergency fund is a financial cushion during challenging times, allowing you to cover unexpected expenses without dipping into your investments or debt. Buffett recommends setting aside 3 to 6 months' living expenses in a high-yield savings account. This safety net can provide peace of mind and financial stability during economic downturns, ensuring you don't have to make hasty or desperate financial decisions when faced with unexpected setbacks. For instance, during the COVID-19 pandemic, those with established emergency funds were better equipped to handle job losses or medical expenses without jeopardizing their long-term financial goals. Moving to the 7th thing to do is to review and adjust your budget. Checking and changing your budget is crucial to your recession preparation plan. Take a close look at your monthly expenses and identify areas where you can trim unnecessary spending. Warren Buffett often stresses the importance of living within your means and avoiding excessive debt. Creating a leaner budget can increase your savings rate, which is essential during a recession. For instance, consider reducing dining out expenses, subscription services, or other non-essential costs. Redirect the money savings into your emergency fund or investment accounts. This disciplined approach to budgeting ensures that you are financially resilient and better equipped to weather the storm when economic uncertainties arise. Remember, every dollar saved today can have a significant impact on your financial well-being in the future. Continuously educating yourself is the last thing to do. Warren Buffett is known for his dedication to lifelong learning. Before a recession strikes, continuously educate yourself about financial markets, investment strategies, and economic trends. Knowledge is a powerful tool when it comes to making informed financial decisions. Consider reading books, attending seminars, following reputable financial news sources, and seeking advice from experienced investors or financial advisors. Buffett's success is partly attributed to his deep understanding of businesses and industries. By expanding your financial knowledge, you can make more informed decisions, adapt to changing market conditions, and identify potential opportunities during a recession. For example, during the 2008 financial crisis, investors with a solid understanding of market dynamics were better positioned to make strategic investments when stock prices were low, ultimately reaping substantial returns when the market rebounded. Remember, education is an investment in your financial future. By adopting a long-term outlook, you align with the principle that the market's potential for growth extends far beyond temporary downturns. And there you have it, Warren Buffett's 8 key strategies to prepare for a recession. From building liquidity to maintaining a long-term perspective, these insights from one of the greatest investors of our time are invaluable. Remember, navigating economic challenges is not just about survival, it's an opportunity for strategic growth and stability. We hope this episode empowers you with the knowledge to make confident financial decisions. Remember to like, share, and subscribe for more insightful content. And as always, keep investing smartly and focus on your financial goals. Until next time.